We're welcoming back Scott Duke to the Cash Rich Exit podcast. Actually, I think when we recorded last time, I was still under the I'm a Millionaire, so now what
Ah,
branding. And then I rebranded and had to re-record an intro because we had recorded anyway. Welcome. We're getting into over 2 years here under the new brand. And so we welcome you back. And you've got some updates to share with us. So,
sure. Yeah, no, Colleen, it's nice to be here and thanks for having me back. Mhm.
absolutely. Um, but because it was 2 years ago, do you mind just taking a moment to share with the Self-Made Nation just a tidbit of like who you are and how you
Yeah,
got to be in
of course.
M&A? Yeah.
Yeah, so I mean, a quick elevator on me. I'm into my 11th company here, so I would call myself an entrepreneur, I suppose. It took a while to like put that cap on and feel comfortable with it. But I have comfort with that now, I guess, having had a few companies under my belt. My background's computer engineering, so kind of what we're talking about today a little bit is one of the valuation tools that we've built. So that's part of, my brain, my engineering brain would have done some of that work. Now I run a business that is in the mergers and acquisition space. It's actually called the Business Succession Group. So since the last time we connected, it was called and still is. I still do have it running on the side under the name Open Road. But we've grown into the Business Succession Group, and we've got about 30, 35 advisors around North America that help business owners transact when they're looking to sell their company. And my team's about 15. So that's the company I'm running now.
Right. So that brings us right up to speed. That's
Mhm.
perfect.
Mhm.
And let's jump right into why I invited you because of this tool that you've created, and give us an overview of the tool, and we'll dig into it a little bit. Of course, we're talking about it, and it's always going to be useful to see it in person, but we'll get to that at the end as to how a business owner here can experience it. But let's start at the beginning. What?
Sure. Yeah. I
Yeah.
mean, the beginning of this, I constantly I have to think over Excel sheets. Like I'm one of those people. Like I feel like you're a Word doc thinker, you're an Excel thinker. Anyway, I'm an Excel thinker. But this came out about because of market demand, I suppose. So basically, I was connected with a wealth planner that was on the island, and they said, "Hey, the Vancouver Island." They're like, "I'm looking to know the value of one of my clients' businesses." And at that time, I'd been into business brokerage and selling companies for a decade. So I said to them, "You're probably your best bet to value a company is just put zero. And then that's your highest probability of the value of your client's company is zero. And that's probably hard for some of the audience to hear, or in
Hmm.
general, that is an entrepreneur. But that's the most likely value of a company, and because 80% of companies just aren't really worth anything. They aren't going to sell. And like part of the discussion and part of me building this tool is to help people with that. And obviously that was a shock to the person that I was speaking to. And she said, "Okay, well, I said, you know what? That's not providing you value." I'm like, that doesn't really give you any help because the 20% of businesses that are valuable, it could be all over the map. Like they could be worth
Hmm.
$1,000, it could be worth like 50 million, right? So that's not a fair assessment, I suppose. And I asked them, would it be valuable if I just created a tool that was quick, was easy for you to use? You could put a little light touch data into it, and it would give you a range of value for the business. And there's certainly tools out there that do this online, like do a free business valuation and that kind of thing. But for the most part, they aren't they aren't really close to accurate, right? So I wanted for this individual, I wanted to be at least close enough to accuracy that you could say 20% accurate and you could put it into the form that's the net worth statement. This is the business owner's value of their business, and that kind of comprises some of their personal wealth. I wanted some accuracy there. So she said back to me, yeah, if you could please make that, that would be useful. And away we went to do that. So that was V1. It was version one of the value acceleration calculator is the name we ended up giving it at the end of
Okay. Right.
and we're now on version 10 of it. And I've probably run over 600 companies through this thing, like literally one-on-one, sitting down with business owners, running them through and doing an exercise. So it's been bashed around a lot and has done pretty much every industry that's out there at this stage. But that was the impetus and that was the genesis of it. Mhm.
Awesome. And so what the name of it again is, because I think I got it wrong. What is the name of it again?
We just like internally, we just call it the VAC, which is
The
the Value
VAC.
Acceleration Calculator.
Yeah.
It is a calculator, like the tool, I mean, which maybe leads into what the tool does primarily. And it has a couple functions. so for the business owner and for the listener, the value that they get out of it is, do I have a sellable asset? Because that's the number one question they need to ask that people don't ask themselves. They ask themselves, what's the value of my company? But they don't ask if it's tradable. And that's the
Hmm.
challenge, right? Because everyone just
The
assumes,
two-part question.
yeah, it's a two-part question, right? And when we think about selling anything, oh, we're selling our car, we're selling our house. These assets, I'm selling my father-in-law's old Equinox right now. It's a Chevy Equinox, and so
Hmm.
whatever, it's got some rust on it, and like we're both in Ontario, so Ontario salts roads, and so you get rusty vehicles over time. But either way, so it's not a high value vehicle. So I go and research like what it would probably be worth, and I think it's going to be worth around 4 grand. So I list it for 3,950, and it's ghosts, like nothing, like just dead air.
Okay.
Like no one inquires for this business, this car. It's got 140,000 K on it. All right, fine. So the market's spoken that I need to reduce the price, right?
Yeah.
But the vehicle's sellable. Like if I put it for 2,500 bucks, it's going to sell for sure. So most of us are used to thinking that the vast majority of things that we own are sellable assets. We just got to find that right price point, and that's why people want to value their companies. But businesses it's a completely different world. The vast majority of them just aren't tradable. They're way too high risk. People that are going to invest in these things are savvy folks. Like they can sniff out the ones that aren't going to be good for them from an investment perspective. So a lot of stuff just doesn't sell. And I'm saying this from experience too, like having
Hmm.
11 companies and having the vast majority of them, like three of them or two of them I sold, one of them still operating. The rest of them just weren't sellable. Like they just shut down,
You
right?
just
So
ground them down.
yeah, and that's the highest likelihood for most people that own businesses of what's going to happen to them, which is part of the reason why I go in these podcasts and create these tools. Like I
Hmm.
that to be the outcome for folks, right?
Hmm.
I want people to create sellable assets. So the first thing the tool does is just determine, is your company sellable? And there's about 16 questions that the tool asks you. And it's like, okay, great. It gives you a grade. It's like, and it makes it easy for folks. This is a school grade. It's like you get an A, you get a B, you get a C, you get a D, you get your not sellable, right? So, and it gives
Okay.
a grade. So it'll give you that. And if you most, I would say about 50% of the businesses that I run through it will be that D to C range. Like that's where they're at as
Okay.
far as a grade. So I would consider them unsellable, or they'll have difficulty selling their business, and that's fine. I tell the people it's not an issue. It's just better to know that so you can fix X, Y, and Z. So the part one does that. And then part two of the tool, which I find is the more valuable part of it, is it gives people the value of their company. And then it shows them exactly what they need to do in their business to increase the value of it. And I'm happy to speak to that. But yeah.
Right, right, right. Okay.
Mhm.
So just to generally recap, it's gonna give a sense of whether the business is actually sellable.
Mhm.
Okay, and then before I move on to B, so on this podcast, we're talking about the Cash Rich Exit podcast, and just because it's not sellable doesn't mean that you can't create wealth from it in another way. It's another
That's
conversation. Because when I talk about a cash rich exit, I'm not only talking about selling it, just how you can properly harvest off cash flow that's
that's right.
built from the business to create your own personal wealth. So that's just aside. So first of all, can it be sold? And is that one way that then you actually create more wealth on your personal balance sheet to last down the road? If it is sellable, then you're talking about a next step,
Yeah.
then a range of values.
That's right. Yeah. And just to loop back, like just so people don't have their bubbles burst and feel deflated, because I don't want anyone to feel that way.
And I'm laughing, but these laughs are like the nervous laugh because, yeah, like, oh my gosh, I've created something and I can't get anything out of it. What?
Yeah.
Yeah.
Yeah. Like and and the market's competitive. Like it is competitive. Okay, the good news, let's talk good news. The good news is there is trillions of dollars with a T that is out there waiting to be deployed into the private capital markets, into
Hmm.
small businesses. So there is a lot of capital that's trying to find a home right now. And everyone always asks me, oh, what's the market like? And I go, the market, as far as the cash that's trying to be deployed, is the strongest it's ever been, ever. So that's good. But the scarce resource is the sellable business. So for us as entrepreneurs, that's our opportunity. Our opportunity is to take the asset that we've built that has given us cash flow through our life, it's provided for our families, it's provided for our communities, it's provided for our employees, and now just do the X, the Y, and the Z that now makes it a tradable asset, right? So getting a C grade, which is the most common grade that I get when I run these analyses on businesses. And again, people can use this tool on their own. They don't need to, sit down with any one of us to use it. But if they get a C grade, it's like, all right, well, at least it's telling me now what I need to do in this business to create sellability. One of the questions that I ask is how much energy do you have? Because that's the actual barrier that I find
Mm,
as an entrepreneur. Because if you're 65, 70, my oldest client was 78, the energy, your tanks, your reserve energy is a little bit lower than the entrepreneur who is 35, right? And we'd all like to imagine that not to be the case, but it just is the case. Like we've run the marathon a little bit longer, and we're usually tired when we're
mhm.
kind of getting into our 60s and our 70s as entrepreneurs. So the available energy to deploy into creating sellability may not be there. So at that
Mhm.
stage, it's like, okay, if it's completely unsellable, like if we're looking at a business that has a below 50% or 40% sellability grade, then you're looking at what you were talking about. Like, how can we harvest this over the next few years to make sure that we're putting enough money away for retirement because we
Right.
can't guarantee that we're actually going to sell this asset. So it's probably not going to be part of our, wealth planning exercise. Whereas if I do have energy and maybe I'm 60 or I'm 55 and I have that 5 years, that entrepreneur is somebody who, yeah, we really should focus on making those changes to the business or improvements so it's attractive to an investor because we're going to get an extra $5 to $10 million at the time of sale. So it just depends where people are at. Everyone's in a different spot.
Right. So that's a really big question. And
Yeah.
it's a question, it's kind of, there's some introspection there for the business owner.
Mm.
And yeah, so let's go down the path. Let's go down the positive path first.
Sure. Yeah, that's a good.
Okay,
Yeah.
the positive path says that there are these opportunities to make changes,
Mhm.
call them improvements. From your perspective, what would be the top three improvements that you've seen that could,
Yeah.
make a difference?
Yeah. So again, I've been at this game for a long period of time, and maybe it doesn't look that way, but I have been. I'm like windburned from this M&A world for sure, and like dealing with buyers and sellers through this. So I got the scars on this one. I ran an event back in 2021 called the Exit Planning Summit. And so I
Mhm.
interviewed I had 30 guests in that at that event, and it ran over 3 days. And basically it was just interview style of me kind of interviewing people. And I asked each one of them this exact same question because I thought it was a curious question. Like, what's the number one thing that you do? And if you distill it, and if I go 30,000 foot view just to make it
Mhm.
easier for people to think about it, what a buyer is buying at the end of the day is future cash flow. That's all they're buying. They're buying future cash flow stream, right? So
Yep.
for them, they're trying to dig into what is the probability of this future cash flow stream becoming realized and what is it likely to be? So what they have is tools to figure that out is your financial statements, so your historical financial statements, and they can use that as a best indicator, but that really is looking in the rearview mirror. But they're looking in the rearview mirror and saying, okay, historically this company's made $5 million a year, and what's the probability of it making that into the future? So really, when we're thinking about risk of our business, we're thinking about what's going to reduce the probability of this cash flow being generated into the future. And so the big ones for small business owner, and I would say it is the biggest one, is the dependence on the owner. And
Right.
everyone's heard this, but I hope that framing it as probability of future cash flow helps because that's like how the buyer thinks about it. And
Mhm.
so how much is the owner responsible for? I'll give you a real life example because it's always easier like to tell stuff through stories because people
Right.
can
Of
remember.
course. Yeah.
Yeah. Right now, we're selling a business. It's an insulation company, right? And so it's an amazing firm. It's like second generation business and large enough that it is attracting like larger private equity firms that are interested in picking this thing up. And so for them, they're looking at the business owner and saying, okay, how many of the customer accounts are tied to this business owner? Because if 50% of the customer accounts are tied to this business owner, when this business owner leaves, there's risk of those accounts diminishing. And the seller and the person who's listening to this that's a business owner is be like, no, 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 it doesn't matter. Like my staff have connection to those accounts and like it'll be fine and I'll stay around for a little bit. But we know in our heart of hearts, we 100% know that there is a probabilistic chance that some of the clients that are directly connected with the business owner will leave when the business owner leaves. no buyer is ridiculous. Like these are intelligent folks, especially as your business gets larger. You're dealing with an intelligent pool of individuals. And so they're looking at you and how you directly connect to the cash flow stream of the business. And when you
Mhm.
leave, how is that affecting cash flow? So I would say that's the number one, like bar none, that's the number one. They're looking at the business owner. So what I tell people to do, my little slogan is every day a step away. It's like every day when you're in your business, if you have 5 years, if you have 10 years, if you have 1 year before you're thinking about selling your company, part of your daily exercise should really be, what did I do today? What am I going to do today that I could delegate to someone else in my organization so this is no longer on my plate? That's the most important question that you can ask yourself when you're thinking about selling your business on a daily basis. Mhm.
Yeah, that owner's trap.
It's the
Um,
owner's trap.
yeah,
Yeah.
yeah.
Yeah. Yeah.
And yeah, so basically what you described is really sort of any asset, the value of it is the discounted future cash flow, right? The basics of
That's all it is.
finance 101, right?
This is
Yeah,
finance 101. That's what it is, right? And so, like to speak and maybe just kind of bring it like, and I know you asked for three things. So number one is owner dependence.
yeah,
Number two is going to be your customer concentration, like how is and the stickiness of your
yeah.
customer,
Is
right?
there one customer
And I
who's
would also look
80% of
at
the
I
revenue?
would say, and these are all finance things, but really at the end of the day, like finance are the big ones because people are just looking at cash flow. It's like how does the cash flow actually roll through your business? Like from a working capital perspective, or like how am I invoicing my customer? How quickly am I getting cash into the machine, right? So I would look at those three things first, as far as a risk profile of your company, because those are the first ones that are going to be looked at by any given buyer.
Yeah,
Mhm.
and when you're talking about revenue, you're talking about, do you have customers on some kind of reoccurring subscription, or is it a project by project as kind
Right.
of two extremes, right? So the
Yeah.
ongoing, monthly subscription is likely more valuable than the chunky, every so often there's an invoice that goes out and you get a chunk of money coming in, from
Yeah, significantly more valuable,
that.
right?
Mhm.
I will kind of walk the next stage of this tool because this is what my most exciting piece of the tool is, just sharing with entrepreneurs how they actually enhance share value. Because most of us don't think about this when we're running our business. And I'm literally speaking with my owner hat on, an entrepreneur hat on. It's like we think about revenue and we think about how much cash is this business generating on an annual basis that I can use for whatever else I want to do in my life, like
Yep.
buy a house, buy a cottage, buy a car, hire the
Mhm.
next person, whatever it might be. So we're thinking revenue and we're thinking the cash that the company is generating. Those are the two things that we're really focused on when we're operating our business. We aren't focused on share value because we aren't thinking about selling our business on a day-to-day basis, right?
Right.
The light bulb that I try and turn on for folks is we can think about that at the same time as we're thinking about operations because they all tie together anyhow, right? So the three levers that owners have, and this is what just literally have in the tool, so you can manipulate the levers for your own company to see what it does to your value at the end of the day, is you have your revenue that your company is generating, which is your first lever. You have I call it efficiency, but it's basically your EBITDA, what you're dropping to the bottom line. And then you have the multiple your company is going to sell for. So revenue, everyone understands. It's like, how much
Mhm.
am I selling, right?
Yeah.
And that's something that people focus on. Entrepreneurs focus on that. It's okay, we're going to increase our revenue. Like next year, we're going to go from 5 million to 6 million. Like that's very much a focus. I
Mhm.
find that it's a minority of entrepreneurs that think about efficiency and their profit margin. And so the easiest way to think about that is every dollar that I bring in, how many pennies am I keeping? I said this to an entrepreneur. They were a large um, tablet company, so not iPads, but like anything else, e-readers, like that kind of stuff.
Right.
With the
Yeah.
largest in Canada that distributed that product, and they were running a 3% profit margin in this business, which is not great. It's kind of bad,
No.
right?
Yeah.
And when I said this to them, I said, every dollar that you guys make, you keep three pennies. And that resonated. Like that,
Yeah.
I could tell that the margin piece never resonated. I'm like, you run a 3% profit margin. But when I said it to them like that, it's like every dollar you bring in, you keep three pennies. It was painful for them. And that's like what we actually want because pain creates change, right?
Yeah.
So
Yeah.
that's the second lever is like your efficiency. It's like how much are you keeping of every single dollar? Because nobody cares when they buy your business about how much revenue you have. That's
No.
that's our ego number. It's like what we tell our friends at the bar. It's like, oh yeah,
The
my company,
vanity number.
it's
Yeah.
vanity. It's like 10 million bucks. Okay, fine. Well, we'll look at companies that are doing 3 million and they make a million. And then we'll look at companies that are making 20 million and they make a million. It's like I would way rather have the company
The first company, right?
way rather. Less
Yeah.
overhead, less capital, all less everything. Same cash in my jeans, right?
Hmm.
So buyers are looking at the cash in the jeans part, and the cash in the jeans part is what the multiple applies to, which is like your third lever, right? So
Right.
most of the work that I do and the way that reason why I created this tool is just to show people how they can increase the multiple. Because your company sells for a multiple of EBITDA, which is a multiple of earnings. So how do we get the multiple up? How do we get the earnings up? Because that's how we're increasing our share value.
Hmm.
So this is what the tool does. Mhm.
Yeah, so awesome. Well, listen, how would a business owner get access to this tool, the value accelerator calculator? It's a mouthful.
Yeah, maybe we need to change the name. Doesn't matter. Like, but we just call it the VAC. It's like,
BAC.
yeah, to get the VAC, they can message you. They can search me up on Google, Scott Duke. I'll pop up, and they can message me, and I can send it off to them. They can message our company, Business Succession Group. We'll shoot it off to them. There's no barrier to getting it. I want entrepreneurs to have it. Yeah.
That's awesome. Well, I'm so glad that you invested some time to come back and share. And this was definitely an update from when we chatted last. Um, okay, a piece of fun, frank advice.
But it has to be fun.
Well, it doesn't have to be fun, but that's what I like to call it. Fun, frank advice. You choose.
Yeah, I would say, like honestly, like I'm going through this part of my journey right now as an entrepreneur, and you have to enjoy the journey. Like you just have to because it's such a brutal grind. And I said to I have a controller in the business, and she's so efficient. Like we'll make a nice chunk of revenue comes in, and she's so efficient. In our company, the second revenue comes in, it gets distributed to like a tax account and a profit account and whatever, and away it goes. And I said to her today, I'm like, just let me know when the big sales come in so I can look at the bank account before you touch it.
I just want to see the number, right?
Because the dopamine that we get as entrepreneurs, because we expenses so much, we don't get a lot of it. So I'm like,
Mhm.
just when we do get it, when you get that little bit of dopamine, you get that tiny win in your day, because you're going to get one win and nine losses, you know?
Mhm.
So just savor the wins. I think that's my advice.
Savor
Mhm.
the wins. That's a really good one. Okay. Well, great. Reach out to me. I'll connect you to Scott, and let's hope we can get this tool in many more hands and increase the number of business owners who are exiting successfully.
Absolutely. Thanks, Colleen.
You're welcome.